Have you ever looked at a stock chart and thought, if only I had bought this stock last year, I'd be rich by now? Or maybe you've heard a friend brag about doubling their money and felt a little envious, wondering if you're missing out. If so, you're not alone. The stock market is full of opportunities, but it's also full of traps that can lead to painful losses. The good news: you can avoid these mistakes and set yourself up for success if you know what to watch out for. Today, we're going to talk about some of the most common investing mistakes that beginners make. These aren't just small errors. They are the kind of mistakes that can drain your savings, shatter your confidence, and make you swear off investing forever. But don't worry, I'm here to help you see through these traps so you can invest smarter, grow your wealth, and feel good about your financial future. 1. Jumping into the market without knowledge. Imagine this. You hear from a colleague that a certain stock has been skyrocketing. Everyone in the office is talking about it, and you don't want to be the only one missing out. So, without doing any research, you take a big chunk of your savings and invest in it. A few weeks later, the stock crashes, and just like that, your hard-earned money is gone. Sound familiar? One of the biggest mistakes new investors make is jumping into the stock market without a solid understanding of how it works. They rely on advice from friends, follow random stock tips, or simply buy whatever is trending. But investing isn't a game of luck. It's a skill, one that requires knowledge, patience, and strategy. Think of it like driving a car. Would you get behind the wheel without knowing how to drive? Of course not. You'd learn the basics first, practice, and build your confidence before hitting the highway. Investing works the same way. Before putting your money into stocks, take the time to educate yourself. Read books, watch educational videos, and follow experienced investors. The more you know, the better decisions you'll make. 2. Overconfidence after a few wins. Now, let's talk about another classic mistake. Have you ever met someone who made a few lucky trades and suddenly believed they were a stock market genius? Maybe they bought shares of a company during a bull market, saw their investment double, and thought, "Wow, this is easy. I should put in even more money." This overconfidence can be dangerous. When the market is going up, even a random pick can make money. But what happens when things turn around? Many amateur investors don't have a plan for when the market drops. They panic, sell at a loss, and regret their decisions. I once had a friend who invested in a tech stock purely because he saw it rising fast. For months, it kept climbing, and he started bragging about how he had the Midas touch in investing. But then, the stock took a sudden downturn, and he held on to it, convinced it would bounce back. It didn't. He ended up losing almost everything he had invested. The lesson here? Success in the stock market isn't about making a few lucky trades. It's about having a long-term strategy, knowing when to take profits, and understanding that the market moves in cycles. If you win a few times, don't let it get to your head. Stay humble, stay informed, and most importantly, stay cautious. 3. Trying to predict the market. Like a fortune teller. Have you ever looked at a stock chart and thought, if I buy now and sell at the peak, I'll make a fortune? It sounds logical, but in reality, timing the market perfectly is almost impossible. Many investors believe they can predict the exact moment when a stock will hit its lowest price, the bottom, and then sell it at the highest point, the top. But let me tell you a secret. No one can consistently do this. Even professional investors with years of experience don't get it right all the time. Think about it this way. If predicting the market were easy, wouldn't everyone be rich? The truth is, the stock market is influenced by countless factors: economic trends, political events, investor emotions, and global news. It's like trying to predict the weather a year in advance. You might get lucky once or twice, but over the long run, this strategy is a recipe for frustration and losses. Instead of obsessing over when to buy at the absolute lowest price or sell at the highest, focus on time in the market rather than timing the market. What does that mean? It means that long-term investing, staying in the market for years, not days or months, historically leads to the best results. Let me share a quick example. If you had invested in the S&P 500, a stock index that tracks 500 major U.S. companies, and held on to your investment for 20 years, history shows that your chances of making a profit would be over 90%. But if you kept jumping in and out of the market, trying to buy low and sell high, you would likely miss out on the biggest growth periods. So, instead of guessing when to buy and sell, build a solid investment plan and stick to it. Whether the market goes up or down in the short term, your focus should be on long-term growth. The first step to smarter investing. Now that we've uncovered these common mistakes, you might be wondering, so what should I do instead? That's exactly what we'll discuss in the next section. Because avoiding mistakes is just the first step. The real key to success is learning how to invest the right way. Before we move on, take a moment to think about your own approach to investing. Have you ever made one of these mistakes? If so, don't worry. You're not alone. The important thing is that now you know better. And when you know better, you can do better. In the next section, we'll talk about one of the biggest emotional traps in investing, the fear of missing out, FOMO. This is a dangerous mindset that leads people to chase after stocks at the worst possible time. But don't worry, I'll show you how to avoid it and make smarter, more confident decisions. So, stick around, because what you'll learn next might just change the way you invest forever. Remember how in the last section we talked about trying to predict the market and how it's nearly impossible? Now, let's talk about something even trickier: your emotions. Have you ever scrolled through social media or listened to a friend talk about how they made a killing in the stock market? Maybe they bought a stock just a few months ago, and now it has doubled or tripled in value. They tell you, "I knew it was a great opportunity. You should have jumped in too." At that moment, you start to feel a little regretful, maybe even frustrated. You think, why didn't I invest back then? I could have made so much money. This, my friend, is the classic fear of missing out, also known as FOMO. It's that powerful feeling that makes you want to rush into the market just because everyone else is doing it. And if you're not careful, it can lead to some of the worst investment decisions of your life. 4. Chasing a stock just because it's going up. One of the biggest FOMO traps is buying a stock only because it has been rising. You see it going up, and your brain tells you, if I don't buy now, I'll miss my chance. But here's the problem. Just because something has been going up doesn't mean it will continue to do so. I once met a guy who got caught in this exact trap. He noticed that a particular tech stock had been climbing for months. Everyone was talking about it, and news headlines were calling it the investment of the year. He couldn't stand sitting on the sidelines, so he bought in at the peak. A few weeks later, the stock suddenly crashed, wiping out most of his investment. What went wrong? Instead of analyzing the stock's actual value, he let his emotions take control. He didn't ask himself, is this company really worth its current price? Or is it just hype? He was so afraid of missing out that he jumped in without thinking. The stock market moves in cycles. What goes up too fast often comes down just as quickly. Smart investors don't chase after stocks just because they are rising. Instead, they ask themselves, is this company actually valuable? Or is it just trending? Am I buying this because I believe in the business, or just because others are hyping it up? If the stock drops, will I still be confident in my investment? If you can't answer these questions, you might be falling into the FOMO trap. 5. Believing that past growth guarantees future success. Another dangerous mindset that comes from FOMO is assuming that a stock that has been performing well will always continue to do so. Many new investors think, well, this stock has been going up for the last 6 months, so it must be a safe bet. But let's take a step back and think logically. Just because something has happened in the past, does that mean it must happen again? If you flip a coin and it lands on heads 5 times in a row, does that mean the next flip will also be heads? No, it's still a 50-50 chance. The same goes for stocks. Many people buy into companies just because they have been rising, without looking at what's actually driving the growth. But in reality, markets don't go up in a straight line forever. Even the best companies experience downturns. A perfect example of this happened during the dot-com bubble in the late 1990s. At that time, tech stocks were soaring, and people believed they would never stop growing. But when the bubble burst, many of those stocks lost 90% of their value or more. Investors who assumed that stocks will always go up were left with massive losses. The smart move? Instead of assuming past performance guarantees future success, always look at why a stock is rising. Are the company's profits actually growing, or is it just riding a trend? Are investors buying because of strong fundamentals, or is it just hype? If you invest without understanding the real reasons behind a stock's movement, you're not investing, you're gambling. 6. Letting emotions lead to bad decisions. Now, let's get real for a second. We've all made emotional decisions before. Maybe you bought something expensive just because it was on sale, or you rushed into a relationship without thinking it through. Investing is no different. When emotions take over, logic often goes out the window. FOMO is particularly dangerous because it creates a cycle of bad decisions. It usually goes something like this. You see a stock rising and feel like you're missing out. You buy in at a high price, hoping it will keep going up. The stock drops unexpectedly, and you panic. You sell at a loss to cut your losses. A few months later, the stock recovers, and you regret selling. This cycle repeats itself over and over again, leaving many investors frustrated and broke. But the good news, you can break free from it. How? By developing a strong investment strategy and sticking to it. Instead of making decisions based on emotions, make them based on knowledge. Instead of reacting to the market, plan ahead. How to protect yourself from FOMO. The best investors don't chase after hot stocks. They don't panic when others are making money faster than them. Instead, they stay focused on their own financial goals and strategies. Here are some simple ways to avoid the FOMO trap. Have a plan. Before investing, know exactly why you're buying a stock and what your long-term goal is. Ignore the noise. Just because others are making quick money doesn't mean you need to follow them. Focus on your journey. Think long-term. Short-term gains are tempting, but long-term growth is where real wealth is built. Trust your research. If you understand what you're investing in, you won't feel the need to follow trends blindly. The bottom line, FOMO is a dangerous game, but you don't have to play it. You can choose to invest smarter, stay calm, and build wealth the right way. What's next? Building a strong investment strategy. Now that we've talked about the emotional side of investing, it's time to take things a step further. Avoiding mistakes is great, but what about actually making good investment decisions? That's exactly what we'll cover in the next section. We'll talk about how successful investors build solid, long-term investment strategies that help them win in the stock market, without relying on luck or emotions. Stick around, because what you'll learn next might just change the way you approach investing forever. At this point, you already know what not to do. You know that jumping into the market without knowledge is like driving blindfolded. You know that overconfidence can be dangerous, and you understand how FOMO can lead you to chase trends and make emotional decisions. So, the big question is, what should you do instead? This is where everything changes. Avoiding mistakes is important, but true success in the stock market comes from having a solid, well-thought-out investment strategy. This is what separates long-term winners from those who burn out and give up. Today, we're going to talk about how to invest wisely, calmly, and effectively, so you can grow your wealth without the stress, fear, or guesswork. 7. Investing without a clear plan is like sailing without a compass. Imagine you're about to take a road trip across the country. Would you just hop in your car, start driving randomly, and hope you get to your destination? Probably not. You'd check the map, plan your route, and make sure you have enough gas to get there. Investing works the same way. You need a plan. Without one, you'll constantly feel lost, unsure of what to buy, when to sell, or how to react when the market moves. And trust me, the market will move, sometimes in ways that will test your patience and confidence. A strong investment plan includes 3 key things. Your goal. Are you investing for retirement, financial independence, or to buy a house in 10 years? Your strategy. Will you focus on long-term investing, dividend stocks, index funds, or value investing? Your risk tolerance. How much risk are you willing to take? Can you handle market downturns without panicking? When you have a plan, you don't have to react to every little change in the market. You can invest with confidence, knowing that you're on the right path. 8. The magic of long-term investing. Time in the market beats timing the market. One of the biggest mistakes new investors make is trying to time the market, jumping in and out, hoping to buy at the lowest point and sell at the highest. But as we discussed earlier, this rarely works. Instead, the real secret to building wealth is simple. Stay in the market for the long haul. There's an old saying in investing: time in the market is more important than timing the market. What does this mean? It means that consistently investing and holding quality assets over time will almost always beat trying to make short-term predictions. Let me give you a real-world example. If you had invested $10,000 in the S&P 500, a stock market index that tracks the largest U.S. companies in 1980, and never touched it, your investment would be worth well over $1 million today. That's because the stock market, despite its ups and downs, has historically grown over the long term. On the other hand, If you had tried to time the market, jumping in and out based on fear or excitement, you likely would have missed some of the best growth periods, drastically reducing your returns. The lesson? The stock market rewards patience. Instead of worrying about daily fluctuations, focus on the bigger picture. Invest in solid companies or index funds, stay consistent, and give your money time to grow. 9. Avoiding emotional investing. How to keep your cool. During market ups and downs, even when you have a plan and commit to long-term investing, there's one final challenge you'll have to overcome: your emotions. Let's be honest. Watching your investments go up is exciting, but watching them go down, that's terrifying. Many investors make the mistake of selling in a panic when the market drops, thinking they need to cut their losses. But here's something most people don't realize. Market crashes are normal. They happen regularly, and they are actually opportunities, not disasters. Think about it. When you go shopping and see a huge sale, do you panic and leave the store? No, you take advantage of the discounts. Investing should be the same way. When the market is down, it means great companies are on sale. That's the perfect time to invest more, not to sell in fear. The smartest investors don't react emotionally to market swings. Instead, they stick to their plan. They trust their strategy and don't make impulsive decisions. See market drops as opportunities. Instead of fearing a crash, they view it as a chance to buy great stocks at a discount. Keep their emotions in check. They don't let fear or greed control their decisions. If you can master this mindset, you'll be ahead of most investors. The power of knowledge. The more you learn, the more you earn. The final key to becoming a successful investor is simple. Never stop learning. Investing isn't just about picking stocks. It's about understanding businesses, the economy, and market trends. The more you educate yourself, the better decisions you'll make. Here's how you can keep improving as an investor. Read books by successful investors. Warren Buffett, Benjamin Graham, and Peter Lynch have written some of the best investing books of all time. Follow financial news. Stay updated on market trends, but don't let the news dictate your emotions. Learn from experienced investors. Listen to podcasts, watch interviews, and study how successful investors think. Practice patience. The best investors understand that wealth isn't built overnight. It takes time, discipline, and knowledge. Think of investing as a lifelong journey. The more effort you put into learning, the greater your rewards will be. Final thoughts. Start your investing journey the right way. So, here we are. We've covered the biggest mistakes that new investors make: jumping in without knowledge, letting emotions take over, and trying to time the market. And we've also explored the right way to invest, having a clear plan, thinking long-term, staying calm during downturns, and continuously learning. The next step? Take action. If you haven't started investing yet, now is the perfect time. But do it the right way. Start small, educate yourself, and invest with a long-term mindset. If you're already investing, take a moment to review your strategy. Are you making decisions based on knowledge or emotions? Do you have a solid plan? Are you thinking about the long-term picture? Remember, investing isn't about making quick money. It's about building real wealth over time. And the best part? You don't need to be a genius to succeed. You just need patience, discipline, and the willingness to learn. So go ahead, take that first step. Your future self will thank you.